Building a business requires enormous resources. To secure inventory, hire a specialized workforce, or lease a facility of any real scale, a founder needs capital. Often, they require far more cash than they have in their own bank account. Draining personal savings is rarely enough to cover these initial costs. And while a bank might offer a loan, securing millions of dollars in debt for an unproven, early-stage venture carries a massive and often paralyzing level of risk. Instead of borrowing money, a founder can look for outside investment. They pitch their vision to wealthy individuals, offering them a chance to provide the upfront cash needed to kickstart the operation. This exact dynamic, a desperate need for growth capital without taking on the crushing burden of debt, is the core reason the entire global stock market exists. As this diagram shows, early investors do not just hand over their money for free. In exchange for their cash, the founder must surrender a portion of their company. The total ownership is divided up and distributed to these financial backers. This introduces a critical distinction in finance. Stock refers to the broad concept of partial ownership in that specific business. Shares are the exact, countable units of that stock that an individual investor actually holds. With this sudden influx of cash, the business can execute its vision. Instead of buying luxury items, the founders purchase new equipment, plant new infrastructure, and expand their operations to drive higher profits. If the expansion is successful, the investors reap the rewards. Many companies distribute a portion of their newfound profits directly back to the people who hold their shares. These direct proportional payouts are known as dividends. By bringing in outside money, the founder avoids shouldering the financial burden entirely on their own. The risk is distributed, turning a single person's financial exposure into a collective engine for shared wealth generation. When thousands of different companies are issuing equity at the same time, finding buyers and sellers becomes incredibly complex. Investors need a standardized, highly regulated system to trade these fractions of ownership with complete strangers. That centralized system is the stock market. It serves as a global, interconnected exchange hub where shares of corporate ownership are bought and sold in real time. The overarching direction of this market is driven by collective human sentiment. When investors are optimistic, they buy in aggressively, driving prices upward. This period of consistent growth is called a bull market. Conversely, when widespread pessimism and fear take over, investors rush to sell off their holdings. This triggers a cascading drop in share prices, creating what is known as a bear market. These fluctuating decimals translate raw human confidence into a numeric value, operating as a live, second-by-second gauge of our collective belief in the future. If we look at a risk-reward spectrum, not all equity carries the same level of danger. Massive, slow-growing corporate giants sit on the low-risk end, making them what investors call blue-chip stocks. On the other extreme, penny stocks represent small, volatile startup ventures with a high probability of failure. Tying your entire net worth to the success or failure of a single company, regardless of its size, exposes you to catastrophic financial danger. If that single business collapses, your investment is wiped out. Looking at this real-world exchange ticker, we see a solution. Investors group multiple stocks together into an aggregated pool called a fund. The S&P 500, tracked here, is an index comprising the 500 largest public companies in the market, grouping them into a single entity. By purchasing shares in a broad index fund, an investor mathematically spreads their money across hundreds of different businesses. If one company fails, the others can absorb the impact, creating a diversified and historically stable investment over time. This accessible stability is quite different from hedge funds. Hedge funds are highly aggressive, exclusive pools of capital restricted to wealthy investors, willing to risk total financial loss in pursuit of massive, rapid gains. Navigating the stock market comes down to a specific mathematical choice, selecting the precise level of financial vulnerability you are willing to tolerate. Curious, if a share is simply a digital record of fractional ownership, what invisible force actually causes its price to fluctuate second by second? It is dictated entirely by the strict law of supply and demand. Share prices rise when a large volume of investors want to buy and very few want to sell. When the reverse happens and sellers outnumber buyers, the price plummets. This demand shifts constantly based on real-world triggers. A sudden corporate expansion, a drastic change in consumer buying habits, or even leaked news regarding a secret project can instantly alter how valuable investors perceive a company to be. While the resulting price swings can appear chaotic, the market is not a casino governed by random chance. It is a calculated system constantly processing and reacting to new economic data. Because of this complexity, the mechanics and concepts discussed here are entirely for educational purposes and do not constitute formal financial advice. By understanding how these mechanics operate, everyday individuals gain the ability to step beyond their own labor and tether their personal wealth to the perpetual growth of the global economy.